It's our first in-person event, so thank you guys for coming out today. And first thing people ask me is, why the heck is a marketing guy talking about R&D tax credits? And the reason is because a lot of our clients, we work closely with our R&D clients and our clients' R&D departments, and we have for a long time. I'm a recovering Schlumberger employee, and when I worked there, our whole goal of our department was roll out new Schlumberger technology. So I got really used to working with the R&D departments, and during my time there, I kind of weaseled my way to work, get involved earlier and earlier with them, and it proved beneficial for the company. It proved beneficial for the company, for the R&D department, because made launching their products a lot easier, and it also helped the company because we were able to charge premium prices. We did well against the competition. It helped our stock price. We used all that same content for investor relations meetings, all these things. So I was a big believer then of getting involved earlier in R&D with our clients, and also I'm a big nerd and I like technology. So anyway, when the R&D tax credits, got reintroduced, and Brian will talk a lot more about that. We thought, man, that's something that would be of interest for our clients. We can't help exactly with that, but we know people who can. And so I got introduced to Brian, and he's the managing director.
I'm EVP over the R&D and 179D department. Also a shareholder in CSSI as well.
Great. And so he talked to us, and I thought, oh my gosh, you know a lot about this stuff. And so I think he is going to bring a lot of useful information about what's what, and that what you can expect to be able to claim as a credit, and what you can't. And he's got the rule of 4. He's got some great things for you guys to talk about and understand. And then we got Dustin Williamson. So he is managing director at vcfo, and he brings a perspective of a CFO, and he's gone through these things before, and he kind of knows the timelines and what to expect, and some of the snags you can run into when planning for trying to get your R&D tax credits. We'll talk a little bit about that. And then I am going to bring up the rear, and I have a couple of slides on what can go wrong with the product commercialization. Because at the end of the day, the R&D tax credits are great because you can get Uncle Sam to pay for your R&D. But even beyond that, you're going to need the customers to pay for it. And I think that's what my slides are going to be about. How do you maximize when you launch a new product? So without further ado, I'll kick it off to Brian.
Thank you. So again, Brian Broussard, I'm with CSSI. Who is CSSI? Well, actually, CSSI stands for Cost Segregation Services Incorporated. Primarily, they were a cost segregation company till a couple of years ago. They actually bought my company, who did just R&D studies, and brought it in-house, whereas before they used to actually outsource it to me. But we are primarily cost seg, but now we're actually starting to build up the R&D and the 179D departments. We do about 65,000 studies so far, and we're doing right now about 10,000 cost segregation studies a year. In addition to that, we also do 3115s. We do the 179D energy efficient deduction, and then we'll also kind of go over the R&D here as we're kind of moving through these slides. A little bit about myself. My background is actually as an architect, and you got to probably wonder, how does someone go to tax consulting from being an architect? Well, the economy, right? It can force a career change. So back in 2008 and 9, when it went south, a friend of mine was working in R&D credits. He was an engineer, and he said, you can use your architecture and engineering background to do R&D credits. Didn't really see how that made sense, but I needed a job. So I went to work for a company doing it, and after about 6 months, I realized I really enjoyed it. Did a lot of traveling. I got to meet with a lot of architecture and engineering companies across the country, and then also broke into other industries as well, as like manufacturing and software development. And it's really kind of rewarding to generate credits and watch these people really happy to see they're going to get $100,000 of tax breaks, just for doing something they do every day. So that's what I do now. My job is to build up this division with our company, which has been going pretty insane over the past 8 months after the OBBBA passed. And we're growing like crazy. So now we are here to kind of just educate people a little bit more on it and open up for questions towards the end. And Jenny, I'll let you introduce yourself.
Hi guys, I'm Jenny. I'm a tax attorney by trade. My story to getting into the R&D tax credit is similar to Brian's. When I graduated law school, the economy was terrible. And I had a friend that was working at an R&D tax firm and said, you know, we're looking for lawyers. And so the rest is history. From that standpoint, I have a similar take. The tax landscape in terms of the legislator is very evolutionary, and I find that to be fun because it's always changing, and we get to talk to the R&D tax credit, as you'll see when we go through it, is very industry agnostic because of the way the legislation was written. And that means we get to talk to people across all industries, and I get to learn about essentially what they love to do. So it's been very rewarding, and I've been working with Brian for
8 years.
8 years now. So I came on board with CSSI as well.
So today we're going to kind of hit on some of the basics, overview of the credit. We'll also talk about different industries that we work with that claim this credit. Also go over the 4-part test, which is kind of the bread and butter of the credit, what we use to qualify activities, and then talk about some of those example activities. Also, we'll talk about the commercialization threshold, where R&D starts and stops, and then another key thing is supporting documentation. And then we'll hit on the current legislation, or previous laws actually, but current law and new legislation from the OBBA that made it beneficial again. So quickly, overview of the credit. What is it? It is a tax credit, right? It is a dollar-for-dollar tax credit based on the R&D expenses that you identify. It's available, again, as Jenny mentioned, a variety of different industries. It's not, just strictly for lab coat and test tube type people, but more of a technical approach to problem solving. There are also states that offer R&D credits. So even though you're doing R&D maybe all over the country, you have people all over the place, there's actual states, depending on where that R&D is happening, that you can actually claim credits for those states as well. Each state's have their different calculations, but most of them follow the Section 41 code when we're actually calculating these credits. So some of the basics, again, the R&D credit was actually to keep R&D here in the States. It was enacted back in '81 to incentivize companies to keep it here and not send it overseas. A misconception about R&D is that it has to be patentable or new to the world type technology. The discovery rule in 2003 got rid of that. So now it doesn't have to be new to the world, it just has to be new to the taxpayer. Again, a simple way of putting this is it's a technical approach to problem solving. It is a tax credit, so it's a dollar-for-dollar reduction. It's not a deduction above the line. It's going to be below the line against tax liability. Credits identified. If you can't utilize all the credits in the tax year, they can be carried forward or carried back 1 year and then forward up to 20 years. Documentation is key. We'll talk into some examples of that as well. And then qualifying companies can offset alternative minimum tax as well as a payroll tax. So those are some key things that were actually added in some past legislation. So identifying industries. Jenny, you want to talk about that?
Yeah, so as I mentioned, back when the legislation was written in the early 1980s, really the focus was manufacturing because that was the pain point that we were experiencing in the US by having jobs that were shipped overseas. So the way the legislators wrote the code was very broad. And as a result of that, as industry has expanded over the years, there's so many people that can tap in and take advantage of this. This is a non-exhausted list of industries that can take advantage of the R&D credit. Architecture, as Brian mentioned, that's his background, and so there's a lot of iteration in the architecture industry as well as the engineering industry. And we'll talk more about how what they're making and what they're building fits into the confines of what qualifies for the credit in a little bit. And this is the 4-part test. And this is where, when we start to explain this to our clients, their eyes cross a little bit because it's literally us kind of going through what the legislation says, right? A simple way to look at it is when you have a problem or something that you're trying to develop as a company, you're asking yourself, can I do this? How can I do it? And what's it going to look like, right? And what resources am I going to allocate within the company to get this thing across the finish line? So the first component is new or improved business component. These are all the specifically enumerated business components in the code. Product, process, formula, technique, and then also invention. So as you can see, that's very broad. Software is the only specifically enumerated business component. So for R&D purposes, that is a slam dunk industry. Elimination of uncertainty. That's the part of the process where you're asking, how do we get this across the finish line? There's more than one way to do this. Let's evaluate the best way to do it and see if we can iterate until we get to the right conclusion. Process of experimentation is the iteration in practice. So it really follows a scientific method where you have a problem, you have a hypothesis, and you're going through and seeing how you can get this across the finish line. And then lastly, technological in nature. This is really a checkbox, right? This is to keep out industries that are like social sciences or soft sciences. It has to be rooted in a hard science. So chemistry, physics, mathematics, computer science, things of that nature. So it's an activities-based credit first before we start identifying expenses. And I can't stress that enough because people will say, I have this categorized in my GL as all this R&D spend. Well, what are the activities that are generating those expenses? Once we've identified that, then we look to see what the expenses are.
And the credit is not a success-based credit, it's an activity-based credit. So if you meet the 4-part test and you unfortunately fail with that, you still get to take the expenses towards the credit and generate a credit. And on the flip side, if you're successful and you develop a new product or whatever, and you sell it, you can still take the time and the potential material costs that went into developing that new and improved product. Some examples of the business component, a product is something tangible, right? It's a manufacturing company that might be developing a widget, right? Pretty easy. Process or process improvements. We deal with this a lot when we deal with architecture and engineering companies because they go through a design process from conceptual design through design development, construction documents, and then at the end of construction documents, it usually is ready for bid and permitting. And that's kind of where that R&D stops. Now, then after that, you've got construction administration, but that's kind of a gray area on whether there'd still be activities going on during that time. So we'll talk about commercial production and where that stops, but in engineering and architecture and design work, we typically cut it off at where that those construction documents are finalized and it's ready to go out for permitting. Formulas, I've got a couple of chemical engineering clients actually in Pasadena that do different formulations, and we have to scale these things up in the silos, and it's never a 1-to-1 ratio or combination in their lab. They might mix a slurry in a cup, and they have to, basically scale this up in these, 100 cubic pound, whatever they call it, silos outside, and it's not the same ratio. There is still uncertainty of whether it's actually going to work that way or not. So there's a lot of uncertainty with that, and that allows for us to capture these credits. But regardless of the industry, this is what we use to qualify those activities. And then there's three buckets of cost, three main buckets of cost: salaries and wages, supply costs, and contractor costs. The salaries and wages, that's where really going to be the majority of the R&D comes from. It's employee wages, their time that's spent doing R&D activities. But with salaries and wages, there is what we call a one up and a one down. So not only can we capture direct R&D activities, like an engineer working on something that's R&D related, you can actually capture the supportive role. So maybe it might be a draftsman or an EIT that's involved with that project, and also a one-up role, which is supervisory to the R&D, which might be the owners if it's a small company, or department heads that have knowledge and are actually in on meetings, may not be directly involved in R&D, but maybe supportive to that R&D or supervisory to that R&D activities. Supply costs, those are defined as raw materials that are consumed in the R&D process that do not have a shelf life of longer than a year. If it does have a shelf life of longer than a year, it's probably something that's being capitalized, piece of machinery. So we can't capture that. But there is the ability to capture raw materials involved in that process up to commercial production, right? Because that commercial production, that's where R&D stops and it becomes mass produced.
And I would say too, just to kind of jump in on that, supply cost is probably the most litigated expenditure in the code, right? Because there's so much confusion on what's going to qualify. So I think that's where it really becomes important to make sure that you're working with somebody who is keeping abreast of what's happening in the legislature, what's happening in the courts. Because we get people who ask us all the time, well, I make buildings, can we take this? We spend so much money on supplies. And the answer to that is no, because the code specifically prohibits us from land or improvements to land. And so there's so much to navigate in that specific bucket, but also that bucket for companies that are engaging in true research is such a game changer for the credit. It can really blow up the credit to be super beneficial for them. So just wanted to make that note on supply costs.
And then the last one, contractor expenses, outside contractor costs that you may be outsourcing R&D activities to. There's the potential we can capture those, but we do have to evaluate the contract between the two parties, because you both can't take the R&D activities for the same product, right? Either they get to take it as a W-2 expense or you get to take it as a 1099. And we determine who gets to take that R&D and who's an economic risk by the contract and really the fee terms between the two people. Go ahead, Jenny.
Sure. So it's funny because when it comes to talking about identifying clients, because it's so industry agnostic, that can be challenging sometimes. Obviously, it's very easy if someone is in the software space because they're specifically enumerated. But things that you can do when you're on the lookout to ascertain whether or not your client can qualify for the credit. The form 6765 is the simple form that we put in the larger tax return, and it's very identifying.
It was a simple form.
Well, yeah, it's not simple anymore.
It's not.
Unfortunately, the IRS just is constantly trying to put us in a position where we have to do more work, but that's okay. So the 6765 previously was a one-page form. Now it is 2 pages, sometimes 3. Yeah, okay, so
4 now.
it's getting longer. So that's something that you can easily identify if you have access to their tax return, so that if they've ever taken it before. Now, if you have somebody that hasn't taken it before, that's a different conversation, right? Another thing is that we like to pride ourselves on working with clients to specifically identify what position they're in from a tax paying perspective. We never want to give them, yes, the credit does carry forward 20 years, but we never want to give them a ton of carry forward that they're never going to use. So delineating whether or not they're in a position of profit where they're paying tax or soon to be in a position, because the credit does build upon itself mathematically. So the sooner you get started, you have more of an upper hand, but I am not someone who is going to say you're going to be in losses for the next 15 years. Let's do an R&D credit, because it just doesn't make sense. Let's see. If they're not taxable, are they an eligible small business? There's been expansions to the code from the PATH Act that allow folks who previously had utilization or taxable income problems to be able to avail themselves. So it's just talking with somebody who has a purview of knowing, what position the client is in. And then, like I said before, sometimes this can get you in a little bit of trouble just looking at the GL and saying, oh, R&D, but that is an indicator to start the conversation with somebody, right? It may not be something that we can capture, but if we see R&D, obviously that's a streamline to talk to somebody who can quickly identify whether or not they have qualifying activities, and then in turn, what expenses we can capture towards the credit. Technical uncertainty and evaluation of alternatives. That really is just us, looking at the 4-part test and seeing what's going on from an activity perspective. Anytime you see somebody working on a product at Schlumberger or anywhere where they're like, okay, we need to be competitive. How would we be competitive in this? And a lot of times that involves R&D. And so if you have a client that is engaging in anything like that, then it's a way to essentially cash flow it, right? Because it is dollar for dollar and it does directly impact your taxable income right now. So it's a way to set yourself apart from competition in that way. And then acquisitions, obviously, with acquisitions come new service lines, come new product lines, and maybe a company that previously wasn't able to avail themselves to the credit, they can put themselves in a position now based on what that company does. Another thing that I like to say is the PATH Act in 2016 did a lot of things, which Brian's going to get into a little bit more. But one of the things that is often not talked about that it did was it expanded what qualifies from a software perspective. We used to only be able to take a look at what's called external use software, which is software that's made for sale, lease, or license. That's the most obvious thing where someone's developing an app or developing a software. Prior to 2016, internal use software was specifically precluded from us being able to take a look at. Well, with the environment that we find ourselves in from a technology standpoint, almost every company is doing something to improve their systems internally, and some are really taking it a step further and coming up with enterprise level softwares internally to help their systems. In 2016, we are now permitted, post 2016, we are now permitted to qualify internal use software. It does have to meet a heightened standard, but it was specifically precluded before that. And so now we're seeing, we have a law firm that takes advantage of the credit, which never would have been a thing prior to 2016.
And it went through an audit and sustained it 106% with interest.
They've been doing very, very, very high level technology development for years. And after 2016, now they're able to essentially hire more software engineers to help that initiative.
They were a patent law firm and they were developing patent software for other patent attorneys out there. So that was just one component of their business. So moving on to the next part, commercialization threshold and supporting documentation. So where does R&D kind of begin and where does it end? And that's kind of what we're going to talk about, the commercialization threshold. The main things I mentioned before, if you're a manufacturing company, you're developing a widget, all that time that goes into developing that new or an improved product up to where it becomes ready to go. All the testing that goes into that, all the material selections, everything that goes into that can potentially be captured towards R&D. But when it becomes finalized and it's ready to go, and now you're ready to produce this on a mass scale, that's where R&D would stop. So there is when it comes to the engineering work and the design drawings, we talked about that as well, that when construction documents are finalized, they actually go out for bid and permitting, that's where we kind of stop that R&D. It doesn't mean that in the field that things can't change. It just means that they're not as tracked as kind of granularly as they are in those first couple of phases where that R&D is happening. So that's what we really want to look at. So whenever we're identifying those R&D activities, where does it stop? And then where does commercial production begin? And it's really pretty simple in most cases. I mean, it's pretty obvious when something becomes available for commercial production. So here's some activities, kind of pre-threshold and post-threshold. You can read on it. But again, qualifying research will be under that designing the prototype, that initial steps of where you guys are maybe meeting, discussing different activities, testing out the prototypes, experimenting with different uncertainties, with materials, with tolerances, heats, all kinds of different things. These are all going to be pre-threshold activities that can qualify it. New patents and formulas, improving that functionality and performance. If you think about it, really all this is just kind of talking about different stages of the 4-part test that we're going to ultimately qualify and capture towards the credit. And then, post-threshold, post-production planning for the finished components, tooling up for mass production. Again, if there's tooling involved prior to that component being finalized, there's potential we can take those, that mold and those tools. But after it's finished, then if you tool up for that, we cannot capture those costs. Trial production, troubleshooting for production equipment, and then debugging when it comes to software is where we kind of cut that off for the commercialization portion of it. And then supporting documentation, I'll kind of let you talk on this as well, but as it says here, no one size fits all. Everyone tracks things differently, and the IRS understands that, but they also want documentation if you're going to claim the credit, and they want you to be able to substantiate it. So when we deal with engineering companies, architecture firms, they're great because they actually have time tracking, and they track activities to a project, to a task, to a phase, even notes after that. So it gets really granular, and we can actually really disqualify certain things and qualify other things. But manufacturing companies, they may not. They just may have job travelers that kind of follow a product around. So what we have to do is we have to go in there and assess, one, what's available, and two, we try not to interrupt their day-to-day operations, but a lot of them ask for us, for examples or ideas of how they can track things better. And we'll provide that, but we'll also, consider that, hey, this is your day-to-day operations. We don't want to, impact it so much just for maybe a $20,000 credit. It may not be worth the time to do that. But if it's several hundreds of $1,000s, that may make time to actually, change some of the way they're doing things, the way they're tracking. Again, emails and meeting minutes. The client that she mentioned before, the law firm that got audited, one of the projects that they were developing was a software for the patent industry. And the twin brothers who were the head lawyers there, one of them got the idea while he was in the shower, and he jumped out of the shower, got a napkin, and wrote down the idea on the napkin and kind of sketched something on it. And we know this because they actually had this napkin framed in their office. Right? And that's where the initial idea came from. He loves telling that story about how he got out dripping wet without a towel and started writing things down on a napkin that just happened to be on the bathroom counter. So, there's all types of different documentation. Let's talk about some of those that maybe you've come across.
Yeah, I think this is a pain point for a lot of folks, especially if they are liaised to their CPA, which is how we prefer to work with people so that everyone's on the same page. Everybody has read an article at some point in their life about no documentation, R&D bad, right? So we have to essentially have consultative conversations with these clients to find out what their process looks like before we can give them examples that are canned, right? But we need to make sure that it fits their process. And one thing I always tell clients is the IRS has a documentation requirement, but they don't have a specific documentation requirement, right? So usually when we work with a client in the first year, it's not the gold standard because they're not keeping track of this stuff with the aim of taking the R&D tax credit, right? So we'll get what we can and we advise them on what to do better. And now with so much AI being implemented into the workforce, whether it's like, your note taker on your meeting or like Slack or what have you, any of those things are really great resources to just keep track of the workflow. And that's all we have to show. We do not have to have a comprehensive beginning and end of an initiative. We just have to show that there has been an initiative and that there's been uncertainty that's been addressed by iteration. And so, like I had a call with a client yesterday that was in the software space, and they were like, "Listen, like we're a really small company. We don't have a huge ticket system where every single idea is programmed, but they have phone calls with people. And I was like, take meeting minutes. Like when you guys have a conversation, even if it's just the two of you having a phone call, there should be meeting minutes about, after the fact. And you guys aren't doing all of this without a documentation procedure. I know you guys are going through and there's different features that are being added. There's got to be a paper trail. So we'll dig into emails, we'll dig into messages. There's many different ways for us to achieve the documentation that is required by the IRS. And we try to do that as much as we can on the front end. If in case there is an audit, we don't want them having to go back, all these years later and dig through all of their stuff. So we try to do that as part of our process to get as much as we can to be representative of what would be asked for.
All right, so moving on to current law and the new legislation. So some of the highlights from the current law: back in 2016, the R&D tax credit became a permanent part of the tax code. If you'd ever worked in R&D in the past, it had been something that was always either re-upped or made retroactive for a year and then extended for another year. It was never permanent since the 80s. So finally they made it permanent. Also, they did the AMT turnoff, which is eligible small businesses less than 50 million in gross receipts for the prior three-year average can offset AMT. They actually did that back in 2010. It was really successful, and a lot of people really claimed the R&D credit that actually were in alternative minimum tax, and now they can actually offset AMT with R&D tax credits. And then qualified small businesses, these are for companies that are startups that are less than 5 years old and less than 5 million in gross receipts. They can offset the payroll tax. You can't amend for the payroll tax offset. It's only on the next full quarter after you file your current year return that you can offset that payroll tax. So the new legislation, do you want to go and talk about some of that? I'll hit on some of the other ones.
Yeah, so before this legislation was passed last summer, there was a sunset provision that was part of the PATH Act that I talked about. And without getting too far into the weeds, prior to tax year 2022, you had the choice as a business owner as to whether or not you wanted to amortize your qualified return expenditures or 174 expenditures that fall within that bucket over 5 years or immediately deduct them, which is not really a choice, right? You're obviously going to immediately deduct them because that reduces your taxable income. In 2022, the PATH Act sunset, and there's a long, litany of people that were, there was a lot of legislation that tried to get passed in order to circumvent that from happening, but it did happen. And as a result of that, companies were being put in tax-paying positions that they couldn't have even imagined before.
Let me give you an example. One client has $1 million of R&D expenses in 21. They deduct that $1 million, they get a $100,000 credit, just being estimates here, and offset $100,000 of taxable income. In 22, that same $1 million, they can only deduct technically 10% the first year. So they deduct $100,000, which leaves $900,000 to be amortized out, but also leaves $900,000 in taxable income. If you don't have anything else to offset that, you got a $300,000 tax bill. Now you got a $100,000 credit to offset a part of that, but you're still in the red $200,000. Same thing for 23. You get 10% of 2023, but you have 20% of 2022's carrying forward. So now you're at $700,000. You're still going to have about a $225,000 tax bill. You still have $100,000 in credits for 23 to offset that, but you're in the red. 2024 is supposed to be a breakout, kind of a break-even year, maybe give or take. But with the new bill, they actually repealed that requirement for not everybody. They repealed it for 2025 for everybody going forward, but for people that actually amortize those expenses for 22, 23, and 24, they can actually go back and amend those returns and kick out the amortization and expense everything 100%, which would generate refunds. You have the choice of whether you do that or not. Either you could do that if you were under 31 million in gross receipts for that prior 3-year average, or you could just wait until this year and catch everything up in 1 or 2 years. So you could do all the expenses in 25, or you could split it up between 25 and 26. Majority of our clients are doing them all in 2025, and they're going to have huge deductions going forward. So they're going to put themselves in a position to where we're still doing studies for them, and they're going to accumulate credits because those deductions are going to completely wipe out their taxable income. And so they'll generate these credits, they'll carry forward in the next year and the next year. And when they actually run out of those deductions, they'll have credits, probably 2 or 3 years of accumulated credits to tax plan and offset tax liability. But yeah, like Jenny said, there was several bills that this was supposed to get fixed in, and it didn't. So there was a lot of uncomfortable conversations with people who didn't realize the impact, even though we explained it to them as many times as we could. They didn't realize it until they got that first, kind of tax return in 22 that they owed a lot of tax.
As opposed to offsetting.
Well, yeah,
Literally the
of course
opposite of what
offset.
was supposed to be achieved.
So this is a big win for everybody, and for 2025, R&D is back to the way it's always been. 100% expensing in the year identified, and you take the credit to offset taxable liability. So some of the other things that the IRS has kind of put forth is the new 65 form. It's more expanded. As Jenny mentioned before, really it was just typically like one page. We'd fill it out, we'd put all the numbers in there, we'd give that to the CPA, and they would actually incorporate that into their software and the returns. But now the IRS is requiring more information up front on this tax return. And now they want us to list business components. They also want a quantitative breakdown as well as a qualitative breakdown for the amended returns, which is going to be narratives and descriptions of the R&D activities and the projects that they're working on. The main difference here that's going to be really involved is Section G, and that's where we're actually going to have to list out all these business components. It was originally supposed to be mandatory for 2025, but the IRS came back and allowed us to actually give more comments, and now they actually suspended it for 25, and it'll be mandatory for 2026 if you meet certain requirements. The main thing is taxpayers with total QREs of less than 1.5 million and a current year of less than 50 million gross receipts do not have to complete it. So let me say it the other way because it's probably easier to explain. Who does have to complete it? If you're over 1.5 million in QREs and you're over 50 million in gross receipts, you will have to complete Section G. Good thing is we do that for y'all, right, or for the clients. So we'll list all the business components, we'll list all the employees that are taking it, and we'll do everything we need to do to stay compliant with the new form. And this is another portion of the page. So the first page was about business components. This one here is about the employee wages. They want us to break it down into those three buckets, as I mentioned before. There's direct R&D, there's supervisory, there's supportive, as well as the supply costs, rental lease of computers, if that's a component that we're capturing, and the contractor expenses. And if you haven't written in the IRS yet, you still have time to say, stop it. Stop it. It's already tough enough and burdensome on the clients to provide a lot of information that we ask for, but we try to keep it as minimal as possible. That's really about it for our presentation. It's very high level. We do CPEs on R&D probably once every 3 or 4 months at CSSI. So it's probably about an hour and a half long. So it goes to a lot more detail about specific industries and activities and case studies and things like that. But we just want to give you guys a high level and be respectful of everyone else's time. And I don't know if I've gone over like 5 minutes, but if you have any maybe quick questions or if y'all want to talk about something later after it, we can always catch up later.
Great.
Thanks, afternoon.
Thanks, guys.
Thanks. I have one. So AI's got a lot of software companies going out and using hypothetical data to build their platform and see if they can make the algorithms run.
Mm-hmm.
Then they find people like me to see if someone will actually buy it. Right. So I'm engaged with a client right now where we're going out and getting data from various companies to turn it into a product. Right now it's just a fancy algorithm. Right. So I'm interested in I know there are a lot of rules around the go-to-market activities that can get written off, but is there any part of that type of situation without getting down in the weeds and boring everybody else in the room? I mean, is that worth calling y'all on, or is that just
Everything's worth a conversation to understand a little bit more about what's going on. I mean, it sounds like it's going to fall under software development, and it really just going to figure out what the expenses are and if there's anything there, because we have some clients that that are owners of companies that they outsource a lot of it, and then they don't pay themselves a W-2 wage. So then there ends up being really not a lot of cost that we can capture towards the credit, even though they're doing R&D. They might be sending it overseas. And so it's on a case-by-case basis. I mean, I'd probably just have a conversation with you after this and see what a little bit more specifics are and give you an idea what we think.
Yeah.
I have a quick one if possible.
Yeah.
Would a US-based company with an Indian team doing their R&D, would that be subject to domestic?
Where's the Indian team at?
Where exactly? And they're in India. They're not.
It's where the physical R&D takes place.
Okay.
So yeah, that would be
Even
kind of
if they're under the US-based entity.
We have clients that have W-2 employees that work in Japan that are doing R&D, and we can't capture them because they're not stateside. So I even that law firm that actually just sent a lot of work over to the Ukraine for software development for their patent stuff. Spent $1.5 million last year, and he called me and said, "Hey, how can we capture this?" I'm like, well, we can't. He goes, come on, this is what you're supposed to do. You're supposed to figure this out. I said, okay, I do have an idea how we can capture this. Go to the U.S. Embassy and rent a room and put all those people in that room, because that's technically U.S. soil, and maybe we actually have an argument to claim it. Other than that, the credit's for incentivizing R&D here in the States.
Yeah.
So
That makes sense. I mean, that's the intent of it, is to
keep
bring
it
that
here.
Yeah. That's great. Well,
Oh, thank you.
yeah, thanks guys. That was great. That was really good information. And it's good to know that I could write off my shower time thinking.
There you go.
Do a lot of that. All my best ideas come in the shower. So you can sit there.
Am I good? Okay.
Yeah, that's
Okay.
good. So Dustin, I think that was a lot on the tax side of it, and kind of getting down in the weeds on really thinking about what's going to qualify, what's not going to qualify. Let's raise it up a little bit to the CFO level. What are you guys thinking about? How are you advising your clients when it comes to R&D tax credits?
Yeah, I think that, just a little bit about vcfo. We provide like top flight talent to the lower middle market on a fractional basis. And so in my prior history, I was in tax. So I know enough to be dangerous, but I don't do any tax anymore. But I got exposed to this, to cost seg and to R&D, like back around 2010, 11, when I was a fractional CFO of Live Oak Brewing and in Austin.
Yeah.
And so we did a cost seg study and R&D study on that company. And since then, I've done turnaround CFO work. I've done a lot of in different industries. I've been exposed to it, and now as managing director of vcfo, I run into a lot of different owners and people that are engaged in doing R&D, and it's typically, before, as a CFO many times over, I had the opportunity, I could drive the bus. Now I as managing director, CFO consultant, I can interview somebody and say, hey, have you thought of this? What's going on? Tell me more about your business, and I can flag it. And then I'm more now of a kind of a horse whisperer. I can lead them to water, but I can't get them to drink. And sometimes it's tough. Sometimes it's beyond me, because I'm like, it's for money. Even some of these consultants, like what Brian and Jenny do.
You don't like free money?
Well, you'd be surprised. So we're onboarding a client, and I'm interviewing them, and we're going through it, and I'm like, oh, tell me about your business, what's going on. And one of the things I ask also is, have you done any real estate transactions? Have you built anything? And so I'm really trying to. It's a one-way direction. I'm interviewing them, but then once we engage them, then I tell when we're giving the CFO that's doing all the work, I'm saying, hey, by the way, they have some R&D tax credit things I think that you need to explore. Because in the process, when I'm interviewing a CEO, I was like, hey, are you guys let me interrupt you. Are you guys capturing R&D tax credits? Oh yeah, we're doing that. It's like, okay, well, how are you capturing those? Like, oh, our CPA has it. They have it. And I'm kind of like, well, okay. And then I just move on. And I don't explore it. I just flag it. And so when my CFO comes on board, I'm like, hey, by the way, you need to go look at the tax returns. And if pay attention to the 4-part test, but if it looks like and smells like credit, and because this is the problem that I see almost every time whenever I hear that answer, it's either they're not doing it or they say their CPA has it. And then sometimes where I'm asking about real estate, which is not part of this what we're talking about today, it's like they've either heard about a cost seg study or they haven't. And so if they haven't, they say, "What's that?" I'm like, "Oh, well, okay." And then when we come back in and we're engaged, then I'm making sure that CFO knows to go after that. One of the first things they do, because it is money left on the table, year in and year out. And it's really sad that not a lot of CEOs don't chase these things down. And really, we're not in the business of doing the types of calculations, the keeping up with the tax forms. We're in the business of making sure that they get what they get the information they need to make an informed decision. And so, and that sometimes is the hard part. And then so, a lot of times we'll like on that, this is typically what happens. And it's probably an under $50 million company, and they have a mom and pop CPA firm, maybe one or two. And like, when I was a CFO, like many years ago, I'm like, hey, how come you never did a cost seg study on this building? He's like, oh, we tried that once before and it never worked. I was like, oh, you're fired. It's like a $50 million facility and they never did a cost seg study, and like it's the years passed. And so like, you miss opportunities because people get really insular, and CPAs can be one of the worst. They get in the box and they can't get outside the box. And so that's what we do, is try to push them outside the box to say there are other alternatives to looking at your business and being able to make sure that you're getting all the tax advantages that you can, because it's easy to stay in that box. You're comfortable in the box, and like they have a high trust environment of, like, let's say a CPA, which I'm a CPA, but I'm a recovering CPA. The problem is that what we do is we try to push them into, let's explore that.
Yeah.
And usually those conversations don't cost a single thing. And the thing that we're after is providing value. Like the only thing that we're doing once we make that, like kick it over to, like, let's say CSSI, or, you know, in that environment, is we're there to help support not only the data gathering, but also once the data gathering has happened, decide whether or not it's worthwhile to rearrange like their GL and support. And like when we're after things like when the minutes of the board are happening, we're like saying, hey, let's get this documented. Oh, hey, let's flag that. That sounds like an R&D type activity. Or like, maybe it's big enough and we need to change the GL to start capturing that. And how do you capture that out in the manufacturing plant or in your labs, or things of that nature? And so we kind of work hand in hand, but our job is to really spot it, identify it, make sure that they have the good advice on how do you package that up, because this is what happens with when you have that environment where you might have a single line on the GL, and you take it to that let's say small, even mid-size, and even big ones. You just have this line on your GL that says R&D. Well, there's no study behind that. It's just a line on the GL. And I'm kind of like, well,
Good luck with the audit.
yeah, and like, not only good luck with the audit, but like there's so many other activities. And so once, like, and this is the funny part, once the owner and the CEO, CFO, or not CFO, but like the people that are around the table that figure out, oh, we can allocate some of our time, 100%. All my time has been on this R&D project.
That's all I've been doing.
No, man. So then our job, like I was talking about, kind of maybe being a horse whisperer, is kind of, hey, I know we want to be aggressive, but you know, they're doing their job. My job is to maybe kind of talk you off the ledge here. We'll
That happens a lot. That happens a lot.
Yeah.
We actually have a meeting in New Orleans next week with a CFO who called me yesterday. He's also their CPA. And the owners are really aggressive. They want to capture everything. He's trying to pull the reins back a little bit. It says, y'all come out here, y'all look at our operation, kind of tell us what we're doing and where we can maybe track things better. But I'm nervous about this. I don't know anything about it, so we're going to bring you guys in. So it happens a lot that these people think that once they understand it a little bit more, then they think everything's R&D, and like, maybe not everything, but we'll see what you got.
So and so they go from, like, they had this one line, and they called it R&D, and it was just according when, and the tax account just took it, and they either deducted it or they just like accredited, and that's what they thought they were getting, and then that's why we come in and say, hey, let's look at that. I want to see that. Show me tax returns, and then when we realized that's happened, like, so the interview. So back up a little bit. I'm interviewing prospective client. I'm talking to the CEO. I was like, hey, what are you guys doing for R&D? Like, oh yeah, we got it covered. The CPA does it. So okay, duly noted. Then I come back, and once they're engaged, I tell our CFO, I was like, hey, I need you to go do this. And if that CFO doesn't have a tax background, it's like, hey, give it to me. I'll look at it. It doesn't. I mean, like whenever I'm doing it, it doesn't cost anything. But like our CFOs are doing by the hour. But then that's what opens the door of. I think we have a problem, but sometimes it's a delicate balance, because we don't they have a high trust environment. We're not going to go out and like make their CPA look like an idiot. But what we're going to do is like say, hey, I think you need to have somebody specialized look at this, and then that's when we'll kick it over and say, and they'll do like an assessment, and it's usually free, and then they'll say, hey, I think there's much more here, and then that's when we can start opening the door. Notice there's not any of that stuff that I'm talking about, other than like time involved in trying to help capture or funnel information, is not something that we bill for. It's just a value added type activity. And so that's really one of the critical things to understand about how companies see it, how they work, and then the walls, the psychological walls that might be there to get from point A to point B. It's like, I mean, this guy, like, he's like, hey, we have it covered. I don't know about that. Like, but I'm not going to call him. I was like, I'm not, like, unless, like, the baby's really ugly, like they've done nothing. Like, am I gonna like just stand up and just start jumping up and down about
You're a
it?
liar.
No, it's never like that. It's like you just got to be delicate, but you got to push. And sometimes it's a hard push, and sometimes it's an easy one. It just depends on the mentality of the people that we're dealing with. So
It's funny you say that, because when I called, when I guess how I got down this rabbit hole, I was asking our CPA about it,
Yeah.
and I said, what do you know about the R&D tax credit? And he said, well, in a more rude way, nothing.
yeah.
And he's like, but I know a guy who does. You should talk to him. And that's how I met Brian.
Yeah.
But yeah, so I think if somebody tells you their CPA has it covered, they probably definitely don't have it. He's like, I would go to jail for.
Yeah.
That's the kind of stuff I go to jail for, so I don't stick my nose in it.
We
Yeah,
have
no,
about
but-
3 clients that we picked up that their CPA had done the RD credit for them, and everyone was wrong. They didn't do a base analysis on the credit. Their base percentage jumped all over the place from when they started R&D to where it was. I've never come across one that they've actually done it right, and they don't need to know it. I mean, we specialize in 25 pages of the tax code. They got the other 1,000. They're not interviewing employees. They're not meet before part test. So I never throw a CPA under the bus, because that's the bread and butter of where our business comes from. I mean, I always try to say, hey, you know what? Maybe there's some other areas we have to look at that maybe not might be all. That this new legislation is passed, and now we can capture that just to kind of make sure the CPAs save face there and keep them happy and keep the client happy too. To where I think he left a lot of money on the table for prior years.
Yeah, no, it's a delicate balance. Like for sure. I mean, like we get a lot of referrals from CPAs, and like it's one thing to you want to get the best for the client, but you also don't want to ruin the relationship. And so we certainly are observant of that. But if you see us coming in and we're kind of getting a little pushy, then that's what's happening. So, but at the end of the day, a lot of that is like how you capture it. And one of the things that we are really big on is making sure that it's getting captured. And so, because sometimes the work that you guys do to be able to go backwards and try to frame that to where you can have a defensible position on it is sometimes a little bit more of a investigative work.
Yeah,
Forensics.
truly.
We'd rather not be having everybody checking or backtracking. So
Question. One of you mentioned that, or maybe it was Richard, that said that the R&D credit is for innovation new to the individual company, not new in
Not new to the
the user universe, right? So I know, Richard, you're going to kind of go down a product development route here momentarily. Does the R&D credit cover the implementation and integration of, say, new technology,
yeah, I mean,
Yeah,
my perspective, but
whether it's AI or something else, like the whole?
Yeah,
The whole process
you're
of
talking about someone else
experimenting.
using AI for something else, and maybe they're doing the same thing as this client over here, but this client's the first time they're doing it. Yeah, they would
Yeah.
actually qualify for it. Well, even though the other client might do almost the exact same thing, it's based on a taxpayer and not new to the world, but new to the taxpayer.
And I think one thing that people forget about a lot of times when they read the 4-part test is it's a new or improved product. Like, it doesn't have to be a completely new thing. We have to be careful when we get into the improved product, because we have to make sure it's not just an adaptation. But if there is significant work or features being added, then that's absolutely something we can qualify.
Like that would be an interesting place to draw the line. So think about our clients that, you know, they'll have these different versions of things that they release, and sometimes it's very novel change, and other times you go, well, and they're doing it to track new technology revenue in their organization, so that you can say, hey, this is how much money we make off of new technology in our organization, but that might not hunt with, you know, getting the, you know, that in there if it's just a new feature added. Where do you draw the line on that?
So it really just kind of goes on what the facts are. If you're really just kind of adding a new feature to maybe like a software, that's really going to be an adaptation kind of an existing business component. So that's actually specifically excluded. But if you actually change, you know, the entire use of this new software to do something different.
What about a hard physical product?
Same thing. You can't develop a widget and then add on maybe another thing that just does something different onto it. It's got to have a new kind of function, I guess you would say. You can add on to something, but you know the rule would be more, what's the new use for it, right? Is it really the same use as with a new feature like, you know, Microsoft Excel doing the add-on with the RGB merge or whatever? No, it's actually got to have another function to it, you know, something new or improved to what the existing product was.
It's like looking for the domino effect. And I think to your point, like when you're looking at a product, that threshold is a lot lower. When you're looking at a software system that you're trying to adapt, like then you're subject to the internal use software provisions, which is actually a 7-part test. So you have to be really careful that you're delineating what that actual modification looks like, and because it needs to be a lot more comprehensive if it's software.
It can't just be a regular DevOps
Yeah.
environment. Cool.
Yeah, and then one of the other parts that we'll assist with is like when they have a lot of offshore R&D and like we spot it and we're kind of like, hey, you know, what options do you have onshore? Let's talk about that. And so we can see that, you know, something's not going to qualify. You might be able to capitalize it, but we certainly are not like the expert in the business of like going to like we're more like in the farmyard and we like see, you know, full of chickens and we see, you know, it looks like a duck, walks like a duck. But I need an expert over here to help me figure that out. And but we're spotting it, and we're certainly trying to run it up to make sure that they get what they need, but and get what they are entitled to. But a lot of times it gets lost and without somebody like really pushing it, because the package that you get whenever you do, like me as a CFO, like whenever you go through that process, and they have like typically it's going to be almost like a book of the documented activities for the R&D tax credit, and then I'm like me as a CFO, I've engaged them, but then I also have my tax compliance people that I've engaged, and I gave them a heads up, I'm going to do this. And so I'm waiting for their report, like hand it over, and I give it to my tax compliance people, and they've already filled out the forms. All they've got to do is like, I was like, I do not want them engaged at all. And the depreciation part for CASEG or for R&D, I want them to take the forms and put it in there. And if they have some type of objection, I'm going to give them the documents, but they're in the business of defending that R&D tax credit. And so from my perspective, I've like been a part of that process where I'm like making sure I'm in those interviews where they're interviewing our lab people or the R&D people that are involved, trying to allocate some of the time to those activities. But so as a CFO, you're kind of like watching the process and helping it and facilitating it, but you're not the one that's actually doing that. And so that when you see the difference between what's happened before and then what comes in after, it's really eye-opening. Like the amount of work that goes into it. And if you're talking about a couple $100,000 plus for R&D tax credits, it's usually worth it.
I would have to think that in a firm like yours that has a broad array of industries they've worked in, and you've seen what's worked in similar companies, could really help you identify the flags that you want to look at.
Yeah, I mean the way that we see it is like, hey, we flag something like that, and a client gets a couple $100,000. I'm like, pays our fee. I mean, like, and then some.
Yeah.
Like, how do you, and that's a small component of what we do, but it's one of the first things we'll go in and flag is doing that. And then we're on the side of helping strategically go on what if scenarios and attacking new markets and helping them like navigate, their business like going forward. And this small side project just paid for like our fee. So it's basically like having a free CFO.
Can you just talk about timing in what you'd love for people to turn up with regard to I know we've talked about documentation. Timing's critical because 25 we got to get it done before whenever in 26, and then what would your ideal client turn up with?
So I guess from a timing standpoint, let's talk about first the time spent on your side. I mean, you take the credits, you're probably already aware of this. We do 3-phase analysis. Phase 1 is estimation. Phase 2 is the qualitative and quantitative phase. That's where we dive deeper into that 4-part test, the activities, the projects, and ultimately qualify those and put the forms together. And the final stage is reporting. In phase 1, gathering financials like tax returns, W-2s, project list, time tracking. Honestly, I don't think it takes longer than maybe an hour, hour and a half. And usually the owners delegate that out to the office manager. Phase 2 is a little more involved. I'd say depending on how many projects we're capturing, it might be like a 4 to 5 hour process over different people over maybe a month or so. We're interviewing maybe 4 or 5 different project managers on 4 or 5 projects each. We're spending about an hour and a half, and then we're gathering information, we're gathering documentation. And so maybe 4 or 5 hours in phase 2. And then phase 3, there's not really much involved on the client side other than providing them maybe a sample of the write-ups or the case study that we've done for them to review to make any edits or any corrections that we might have missed or something. So that, from a study standpoint, that is very much on our end. When we're talking about filing, tax season, we try to get a lot of our clients started in December. A lot of the clients that don't have time tracking may be kind of wrapping up at the end of the year. Everybody's going on vacation for 2 weeks. So there's not really going to be any R&D at the end of the year. So if we get with them in the first part of December, start getting documentation, start getting things scheduled, and then maybe get the W-2s after the year is over, then we're already ahead of the game. We're providing numbers by, probably by early February. A lot of people that do wait to the last minute, I've got a lot of people right now that I had a conversation with a client, and we estimated their credits to be about $50,000, I think, for 2025. It's like, I don't have time for that right now. I said, I understand. Do you plan on extending or do you plan on filing timely? Well, we'd like to file timely. I said, well, do you have another job right now, that you guys are working on that's going to pay you $50,000 for about 4 hours worth of work? And that's kind of how I present that to them. And he's kind of laughs. I'm like, well, I'm being serious, right? I mean, and it's not really you. We're going to be, mindful of your guys' time. We're going to, try to be as efficient as possible. But if you want to get it on the timely file return, we need to do it now and, move forward. If you at least maybe plan on extending the pass-through entity from March 15th to April 15th, and you want to file the extended S corp partnership along with the individual returns, that gives us a little bit more time. Our goal is to try to get everything done by the first week of March for our pass-throughs. Then our C corps, we don't really have too many C corps, but those are 415. But a lot of our C corps typically extend. I say that when we're looking at clients, the majority of the smaller clients would like to file timely. The big ones are always extending because they've got so much more going on. It's not just the R&D. So we don't really, push them too much in the first part of the year. But, if we always follow up with everybody at the end of the year and ask them, do you plan on filing timely? And everyone says, we plan to. But if I see a history, of them, I say, well, you guys have been filing in September every year, but we'll get ready for it just in case. At least you'll know from a credit standpoint, hey, if you don't have to pay $100,000 in tax, maybe you only have to pay $30,000, then they may decide they want to file timely. And so, our goal is just to kind of, as soon as possible, figure out what their situation is.
Yeah, that makes sense. Good.
Did that answer the question? Okay.
Good. All right. Well, I know it's time for drinks, but I'll bore you guys with a few slides really fast because I think this is where, like I said before, these guys will tell you how to get Uncle Sam to pay for your product commercialization. We always are used to talking about how to get your customers to pay you for it. And when you roll this out, and there's no guarantee of a success. In fact, the odds are against you when you launch a new product. Everybody always remembers the successful stories. They're always like, oh yeah, the iPhone was a great product launch and all these, they always remember the good ones. But I came across this survey where Gartner in 2019 said that only 11% of organizations reported that their new products met their defined commercial goals. And that's a little depressing because you guys are better at math than the marketing guy in the room. But 89% don't make it or don't meet their commercial goals. And they given this was back in 2019, I thought, well, is there a newer survey? And I couldn't find one. And I asked my friend ChatGPT if there was a newer survey, and they said no. But in fact, it's probably worse than that now because the pandemic changed the way people buy, changed a lot in the market. So let's be generous and say it's only 10%. But so the question is, why is that so? And what is that? And Gartner identified 4 reasons for that. The first one is they said that there's inadequate market analysis. So that means a failure to thoroughly understand the competitive landscape and the specific pain points of a target audience. And we see this happen a ton. I think what we see with a lot of clients is they have maybe a large product roadmap that they're trying to roll out over many years. And they did initial voice of customer research. And then all of a sudden they, the landscape's changed. New people have, competitors have responded. All these things have happened, and they didn't go back and ask their customers if they still really want this stuff. And that can cause real problems. And I think that leads to the second problem that they found, which is poor product market fit. So that means that the offering is not effectively solving a pressing problem for intended customer base. So we call the pressing problem, we call those bleeding from the neck problems. Customers like to solve bleeding from the neck problems fast. And if it's a nice to have, they will think about it. And that's a polite way of telling your salespeople we'll never see you again when they go pitch it. And so the third one is internal misalignment. So this is another one we see a ton where, management thinks that this new offering has a certain amount of potential in the market. Salespeople might think it's another area. Operations may only feel like they can deliver half of what management thinks, and nobody's on the same page because they didn't really clearly lay it out with their teams. This goes for hard products. This goes for software. This goes for, services. We work to productize services for our clients as well, and it's always the same story. And then the fourth one is ineffective launch strategy. And that just is a poorly executed go-to-market plan when they go to take it in. And so, we had one client that spent $100 million developing some seismic technology, and they didn't want to pay anything to launch it. And then that's going to be the best kept secret approach to marketing is not what we recommend because you want to get paid back for all that huge investment in the market. And so, how do you avoid these things? Well, first, before I get into how to avoid them, we'll talk about what is commercialization strategy is the way we see it. This is BlueByrd's definition. So we see it as a commercialization strategy as a comprehensive and systematic plan that guides a company in successfully bringing a new product or service to market. It's a blueprint that transforms an idea into a profitable, sustainable offering. And for visual people out there, you've got the R&D part of your company, and it's this nice little safe cocoon where you can explore ideas and build, prototypes and all these wonderful things. Test it, put it in a heater, put it in a, pressure test bays, all those good things. But then one day it's going to have to go out to this hard, cruel place called the market where you got competitors sniping at it. You got customers complaining about it. You got investors telling you're not making enough money fast enough with it. And it's a lot more harsh environment. But the commercial strategy should bring those two worlds together. So bring that voice of the customer earlier into the R&D to shape the product that you're going to develop. And also bring in people that are going to be nice in the field testing and gather case studies and, all those kinds of things. So you can merge it into the market a little easier. And so why is that important? So really it's going to increase your chances of market success if you have a good strategy than if you don't, right? It's pretty obvious. It positions your brand as the innovator. Because if you think about how people form their opinion of what an innovative brand looks like, it's because of the products they launch. That's the way they do it. And if you're rolling out cool new offerings all the time, people see you as an innovative company. It's a powerful way, and I call it a new revenue driver. not that it is new, but it's a new revenue. So if you launch a product that in a segment that you didn't have a product before, that's a whole new chunk of new revenue coming into your organization. And a lot of our clients track that number, and they report it to their investors, and they get rewarded for it. And then it helps to maintain stronger margins. So if you're really releasing something innovative and differentiated, you should, in fact, we really insist with our clients that they should charge a premium for that when they roll it out. Because if not, you're never going to pay yourself back. Unless I guess Uncle Sam paid you earlier. And then the last one, it fires up your employees. When you work for an innovative company, the people that work for you walk a little taller. They feel like they are, working for a winner, and it helps you recruit. When I was at Schlumberger, they were seen as innovators in the industry, and they recruited people from the top schools and the top 3% of the top schools, and so it helps with recruiting as well. So how do you do it? How do you avoid those 4 mistakes? So I'll just walk you through really quickly. So to avoid inadequate market analysis, you got to understand what customers value, not what they want. One of our friends is the CMO or Chief Technology Officer at NOV, David Reed. And he told me that they did a lot of studies where they would do all these kind of best-in-class voice of customer research things where they would bring in their customers and do these client advisory boards and talk to them about what they want. And he said, and I said, those are really great. We should do them. And he goes, they're crap. And so why do you say that? And he said, well, because, it's like doing these things is like walking into a room full of kids and saying, who wants ice cream? Raise your hand. And all the hands are going to go up in the room. But if you tell those same kids, okay, who's going to clean their room before we go to the ice cream shop? A lot of the hands are going to go down. And he said, those clients in the room are going, yeah, we want all those features, but they are not going to commit to pay for it necessarily. And we don't ask that question at that board. So we use a technique called conjoint analysis, where you can look at different feature sets and see if the customer is willing to pay you for that or not. And we get really clear data where, they're like, if you put these 2 features together, it is going to be a winner. This one's these are all table stakes. They don't care anything about that. Don't talk about that in your marketing, anything like that. But these are the things you got to bring to market. And if you can get a real premium over what's in the market today. So that's a really good way of doing it. But that's what you got to do, is understand what they're going to pay a premium for. And then avoiding internal misalignment. So the way we say you get around this is by getting fingerprints on the gun. And you got to get, and the way we do that is through workshops. So what we do is we bring everybody together in the room. So we bring in the product people, we bring in the management team, we bring in the sales team, the marketing team, and everybody get aligned on what we were trying to do. And we ask them to do homework before that, and we tell them what the goals are for this. And every single time, Cindy and I just did one last week, and everybody had totally different numbers. And so we get everybody on the same page and say, what are we really trying to do here? And we let them kind of bash it out. What's realistic and what's unrealistic, and should we go for it anyway? Because a lot of times people under predict what they can do in the long term, but over predict what they can do in the short term, we found. So that's what we're trying to do. Get clear on the goals, get clear on the responsibilities, who does what by when. And then to avoid poor product market fit. This is one that is if you do your market research, it helps you get around that. But one of the things that we found is that product market fit is oftentimes blamed for poor positioning. We see this a lot. And where that starts is when an R&D team says, hey, or gets told, you guys need to go engineer these feature sets, go nerd it out in the lab and go make this happen. And here's how much your budget is. Here's how long it's going to take. Here's your roadmap. Go. That's what they do. And they go and they think about those features night and day, and they go and they think about it. And then when it's time to launch it, they say, look at these beautiful features we developed. And the problem with that is, of course, nobody buys features. They only buy benefits and pain relief. And they don't think about that when in the engineering process. And that's all they want to talk about when they go to market. And so it goes to market and it's not positioned in a way that customers will find it appealing. And then They don't talk about their differentiation, about how it's different from the other things on the market clearly enough. And sometimes they don't even really know if it is different from anything on the market. A lot of times clients will come to us and say, here's our new thing. There's nothing else like it. And we do about 15 minutes worth of research on their competitors' websites. We find that there's everybody does it. and so you got to, and the other thing that's with our clients, they always have very complex buying centers. And they can't, it's not just, I can't just go to Dustin and say, hey, we want to buy this thing. And you go, yeah, sure, let's do it. Let me sign the PO. That doesn't happen. And so you have to convince a whole committee of people. And so you have to be able to convince all those people in that buying cycle of your, of the value that you bring and how some of those features we said that we explore, some of them are to this person and not, and another person that buying center will find it a threatening thing. So as you coach your salespeople to sell it, you got to tell them, don't ever say this to this driller because he's going to choke you. But you can say this to the geologist because he's going to love it. And then just a real quick look at poor product market fit versus poor positioning. So a lot of times, the textbook definition is that offer has no value or utility. But I think with positioning, it just doesn't have a perceived value or utility. You have to point it out. And the reason that happens a lot of times, if it's something, a new offering, and it is truly innovative, people aren't used to buying it. They're not sitting around waiting for your company to develop some wonderful new widget. They're doing business already. And you got to tell them what this is about and how it's going to make their life better. And also, they say they don't have a large enough customer base. Well, a lot of times you just have to segment that audience and don't talk to the people who are not a good target audience and talk to only the people who are the right target audience. And then finally, the one we hear a lot is the sales guys tried to sell it. They couldn't sell it, but they didn't properly train them on how to sell it, right? They got the fact sheet from the engineering department and they went in and started talking about features and stuff sell. And then finally, the last thing is avoid an ineffective launch strategy. And you got to launch for success. So, put the right amount of resources toward it. If you see there's a big upside for this, go, tell it, tell it from the mountaintops and, make a big splash at the trade show. Email people, all those things. If you think, well, it's just a little upgrade, don't spend a lot of money on marketing on it. Just tell the salespeople about the new features and go tell them to go sell the new features, because that can work in those situations. In order to right salespeople. And then one thing that we always tell our clients too is don't launch it. This is something we were terrible at Schlumberger. We launched stuff and we just moved on to the next thing, and we didn't really do a lot of aftermarket support to help keep things going because we were on to the next. And that's something that is really important because you're going to get market feedback. And you could change your messaging based on what you're hearing from the customers. And a lot of times, if it truly is an innovative product, customers are going to find cool ways to use it. They're going to find new value in it that you didn't know in the engineering phase, and the marketing people didn't say, hey, what might this be a benefit? So definitely listen to that. So in summary, avoid those mistakes. Don't do it if you can. And really think through all the variables of how to build a strong strategy and plan, and go into it eyes wide open, make sure everybody's all on the same page, and invest appropriately for what the market uptick you hope to get. And just a little pitch is we do commercialization workshops. Most of the time they're in this room. We travel all over the world to do them as well. But yeah, that's what we do is we try to help our customers avoid making all these mistakes. And that's really what the whole workshop was based around, was solving those same problems that we saw over and over. And there were some things that Gartner missed that we also do. But as soon as we've done it for big companies, little companies, mostly technical companies, but software, oil and gas, life sciences, all the technical people, that kind of stuff. So that's us. Any questions about that before we move to the beer and wine section?
Do you do B2C?
A little bit, but only weird problems. Like Fajita Pete's was a logo that you saw on there, and the only reason we worked for them was because they were moving into northern states where it's more challenging to sell it. Selling a fajita to a Texan is pretty easy. You want to buy, you want chicken or beef. But just saw one this morning in Michigan. They're like, "What's a vagina?" And so they're like, "How can we penetrate these new markets?" And so it's a little more challenging than a normal B2C sell.
Okay.
Do you find yourselves dealing with a lot of SEO requests at all, or?
Oh yeah, that's a big one. And now the big thing is GEO that everybody's all fired up about.
Geofence?
No, so GEO is generative engine optimization. So what we saw it on our website, we saw on all our clients' websites last year in about October, I guess it was, that everybody's traffic dropped about 30%. We were going, what the heck is going on here? Well, that's when Google launched their Gemini search agent at the top that gave the answer right there, so they didn't have to go to people's websites. And so everybody's trying to crack that code right now on how to get that traffic back. And it's simple and it's also easy because it's the same thing that happened before. It's all about content.
Yep.
You got to have a lot of content because that's what it's scrolling around is looking for content. And that's why websites like Reddit and
Really
Wikipedia.
refresh content.
Yeah, they want it.
That's been a
They
challenge.
reward fresh and deep content is what they're
But
looking
you're
for.
trying to feed the LMMs the content, and it's the way you push your content to the LMMs that's going to work. Yeah.
That's exactly right. That's exactly right. And now Google even tracks it, like how much traffic came to your website from it alone. It's pretty cool. But
You're trying to feed it value more than just content.
Yeah.
Because
and salesy stuff
getting
doesn't
good.
work. You know,
It's getting good at.
it's gonna be
knowing-
reasonably.
Yeah.
I think we were talking about Brendan, who works with me. I sent him a nasty email over the weekend because I went into ChatGPT and I said, who are the competitors in this marketplace, which is one of the things we do. Doesn't matter what we do. And I wasn't listed. So very cleverly, he set up a VPN, went over to Europe and used a brand new instance and came back and searched it. And there we were at number 3. So it's a very, very complex subject. And I think ChatGPT knows what I do completely. So it just assumed I wasn't talking about me.
Yeah.
If you understand what I'm saying.
Yeah.
So
You poison your
how do
own.
you test?
How do you poison your own
how do you
algorithm?
test? And Brendan got it and I didn't. So
Yeah. Incognito browsing,
Yeah,
VPNs are the way to
it's
do it.
getting more and more and more complicated.
It
to try
is, and
position this up.
And it evolves very quickly.
Yeah.
it does. Yeah. So if
The rankings, if you will.
if anybody tells you they're an expert at it, they're lying to you because I don't know, you're an expert at anything that didn't exist a year ago and it's going to change tomorrow.
But there are also opportunities because there's one company that built their own website and it wasn't able to be indexed by Google, but they were showing up.
Oh,
in
wow,
an
that's
LLM
interesting.
model. So it was like someone goes, "Oh, I found you on ChatGPT,"
Oh,
but I'm like,
wow, that's interesting.
Google can't find it.
That's weird. It's like
So
no robots. That means
it's
you,
like
Claude.
interesting. Yeah, so it is very like
Yeah.
interesting.
And that comes back to the reality that, you can trace it all the way back to when these companies first started in AI. But at first, every company had kind of a specialization that they were in.
Mhm.
Now these companies have multiple models and the models have specializations. So it's hard to keep up with which ones are best
Yeah.
at what kinds of tasks.
Yeah, I noticed that
And
with,
they're always doing new tests and
Yeah.
stuff that,
with Gemini. It's really interesting too because it's like, do you want the fast one? Do you want the well thought out one that takes 2 seconds longer? And do you want the super expert that takes an extra 5 seconds?
It's interesting though, because the more that they advance, the more that we keep finding that, old school, just getting out, like what do you do to talk to a person, to meet with the community, to like do your old school marketing, old school getting in front of people is actually making more of a difference with these models because they're trying to think like people.
Yeah.
They're trying to like looking at people's reactions, people's interactions, and going, "Oh, this is what I'm supposed to do," instead of, "Hey, this is what marketing told us to do," or what the playbook was for pay per click or whatever it is.
Yeah.
It's kind of coming all full circle. It seems like.
It
Did you
really
see that test, that car wash test? I want to get my car washed, but it's just down the block. Should I walk or take my car? And they used it with a couple models, and like most of them came back, well, get your exercise in, walk. And,
Walk
And I
down
think
there
that-
and
yeah.
back and then
And I
take your car.
think, yeah, and I think Gemini was.
You
the
do
one
for a
that came
shower.
back. Yeah. I think Gemini was the one that came back, was like, oh, I think you want to get your car washed, so you could walk, but really you should take your car. Like, so they're all gonna be just going after and trying to make it, yeah, more reason like a person, yeah.
Great. All right. Well, thanks, guys.